David R. Guttery is the president of Keystone Financial Group in Trussville, Alabama. David Guttery and Brandon Guttery are financial advisors and represent Emeritus Investment Company, LLC. Please stay tuned through the end of the video for additional important disclosure information.
Clients and friends, welcome to the first of what will be a series of podcasts that we will host on an ongoing basis. For the time being, the goal is to produce these podcasts on a weekly basis as the COVID-19 situation remains fluid. Ultimately, when the dust settles, we will do these on more of a monthly basis. Through these podcasts, we will continue our observation of the economic impact of the response to the virus, and we'll continue to share our thoughts on current market conditions, as well as the opinions of many economists, analysts, and managers that we follow on a routine basis. Please feel free to share the link to these podcasts with anyone that you feel may also benefit from having the information that we're disseminating through this channel. So let's begin with a market overview. Looking at a current observation of market data, and I say current, this was current as of the close of business on Thursday, the 16th of April. The intraday low for the Dow Jones Industrial Average occurred on the 23rd of March, and the value of the market at that time was 18,213 points. Now, only time will tell if this proves to be the low for the event. The previous market high was established on the 10th of February, when the value of the market was 29,379 points. From that high watermark to the most recent intraday low on the 23rd of March, the Dow Jones Industrial Average was down by 38%. All right, now, since that low point, the market is higher by 5,324 points as of the close of business yesterday, and that's a gain of 29.23%. So with yesterday's closing value of 23,537 points, we remain off recent high levels by 5,842 points, or roughly 19.88%. I've shared with you in previous conference calls the recent opinions of others that I've heard expressed in the national media. I'll reiterate a few of those here. On the 31st of March, Mark Mobius of Mobius Capital Partners suggested within an interview on Fox Business that, in his opinion, the bottom is in, as he described the reasons for supporting his conviction. And on the same day, Sam Stovall with J.P. Morgan echoed that sentiment by suggesting that the market was in and described the areas of the economy within which he was focused at the time. On the 1st of April, Michael Kantrowitz of Cornerstone Macro also suggested that the bottom was in, but he went a little further and said that in his opinion, when the market was comfortable with clarity beyond COVID-19, that we may see a sharp recovery, particularly in high beta and value stocks. Now, since then, others such as Bob Diamond and Larry Cantor with Atlas Merchant Capital have expressed similar sentiments and on the national business media. Only time will tell if they are correct, but as we've discussed within our previous series of conference calls, I do share their convictions. Now, it's important that we keep the bigger picture in mind here. Clearly, it's important to be aware of what's driving the market and what insight other economists and analysts and managers may have to convey. However, while we're preoccupied with the minutia of the minute-by-minute market movement, we can't lose sight of the bigger picture. If you're a client of mine, then to some degree, the investment strategy that we're following is a direct function of the financial plan that we created for the achievement of one or more quantifiable goals. We didn't haphazardly throw money at this market, in other words. The strategy that we're following was driven by a larger plan, and it was shaped by statements of investment selection through which we identified you as an investor and with which we wrapped operational parameters around the strategy. Those remain just as salient today as they did at inception. In fact, they're even more important today. So let's talk a little bit about perspective. As we've discussed within our series of conference calls, it is more important now than ever to recognize the opportunity that you have to make this crisis work for you. By investing through the crisis, you're dollar cost averaging. Well, what does that mean? It means you're acquiring greater numbers of shares at lower prices. And by doing so, you're shortening the duration of the event. All right, well, what does that mean? Well, to explain, consider this hypothetical example. Let's say that a market crisis begins at a level of 1,000 points. You invest through the crisis to its low point of 500 points. When the market returns to 750, it's likely that you've broken even. Why? Well, the value of your initial holdings are still down 25%, but the holdings that you purchased at the low are up 50%. Nominally, you should be near a point of breaking even between the previous and the new investment amounts at that point. Had you done nothing, well, then you would need the market to fully recover to 1,000 before you'll likely be at a point of breaking even. So do you see what I mean about shortening the duration? Think of it this way as well. Let's examine 4 hypothetical investors. Person A invests $1 and watches it decline to 50 cents in value. He stops making new investments, sells at the bottom, and locks in the 50% decline. Person B invests $1 and then watches it decline to 50 cents in value. He stops making new investments and sells at the bottom, but then he buys back into the investment at 80 cents as the market recovers. Well, he just locked in a 30% decline by selling low and buying high, which is the opposite of what you should be doing. Person C invests $1, stops making new investments. He doesn't sell, but he watches the investment recover to $1, so at least he's broken even. Person D, however, invests $1, watches it decline to 50 cents, and then invests another $1. The original investment eventually recovers to its previous value of $1. On the original investment, he's broken even. But the second $1 he invested has now doubled. He has a cost basis of $2, but an account value of $3. So my question is, which of these 4 investors would you rather be? What you do today will have a direct impact on the success, or the lack thereof, of your investment strategy from this point forward, and I hope that this example illustrates why that is the case. All right, so let's talk about an update to COVID-19. I won't rehash all of the data that we've discussed over the previous 21 conference calls on this subject. If you missed any of those calls, however, I will be happy to send a link of that playback to you. The last call that we held was on Monday, the 6th of April. If you've been observing the metrics that are available on the Worldometers site that I've linked within several emails, then you know that the numbers of new cases are declining sharply in the U.S., and the numbers of recoveries are increasing at a faster and faster rate. Indeed, the slope of the recoveries curve on that Worldometers site shows the most steep slope of any curve on the entire site. I've listened to many of Governor Cuomo's conference calls, too, regarding the situation in New York, and clearly the numbers of new hospitalizations, new intubations, and new cases are in sharp decline. So as a result, President Trump and the COVID-19 task force announced yesterday a 3-phase plan to gradually reopen the United States. If you'll visit my business social media, I've posted a link to that 3-phase plan for your review, and I've also sent that link within today's Constant Contact email. By the numbers, current as of Friday morning, the 17th of April, in the United States, we've had 678,210 reported cases of COVID-19. Out of a population of 357 million people, that means that 0.2% of our population has been infected with this disease. As of today, 585,725 of those cases remain open. Again, citing not only Worldometers, but also the World Health Organization and the CDC, it appears that the recovery rate is over 96% for those not in a high-risk group. So given the recent trends of the virus and the improving numbers that the President cited yesterday, and the degree by which social distancing seems to have flattened the curve, the administration seems comfortable with moving forward with a progressive plan to reopen the economy in stages. Now, the markets have been moving higher since the 24th of March, in part because worst case assumptions that were priced into the cathartic reaction to the disease in February may not be proving to be the results that we're observing. If you've watched the news, then you know that the initial models from the University of Washington and others have been dramatically revised downward in recent weeks. As we've discussed within those series of conference calls, markets are discounting mechanisms, and in both directions. Now, the markets are in the process of repricing assumptions made about 2 months ago in light of currently available information. So look, in conclusion, COVID-19 was a strain of SARS that had never been known to infect humans until earlier this year. This was an acute onset of a shock to a market that was at a nominal all-time high. And also, as we've discussed within the previous conference calls, I cited 18 economic metrics that were as strong as we have observed, in some cases going back for decades. Clearly, such economic strength isn't characteristic of an economy teetering on the brink of recession. This acute onset of a shock hit us at a good time, in other words, and the provisions of the CARES Act that we've discussed within those conference calls and in my most recent video are in place now to support individuals and employers. So in my opinion and that of many economists, we will likely experience a short-lived but significant economic contraction. But we may also experience a historically robust rebound beginning in the fourth quarter as a result of the means provided to employers through the CARES Act to continue salaries to those employees and bridge this social distancing gap that has impacted the economy. That's what the market is evaluating now. Today, the market is discounting the potential for that recovery later in the year and into next year, and hence why we've seen the market advance by thousands of points as we've observed historically bad claims for first-time unemployment benefits. So look, stay focused on where we're going. You can't react to a shocked market. If you try to do so, it generally creates a larger problem of having to battle the emotional aspects of when to return to the market. If your objectives remain in the intermediate to distant future, make this crisis work for you. Lastly, we're having Zoom video meetings and intercall conference call meetings, as well as individual phone meetings while we remain unable to have face-to-face meetings. Hopefully that changes in the near future. But in the meantime, while we're trying to feverishly stay in contact with all of you, please never hesitate to reach out to us with your questions and needs of clarity. This podcast, virtual meeting technology, social media, and other channels are just part of a multifaceted approach that we've employed as an effort to lead in this crisis in a visible manner. We will get through this, of that much I can assure you. Thank you for your time, and we will send other podcasts later.
David Guttery and Brandon Guttery offer products and services using the following business names: Ameritas Investment Company, LLC, AIC, member FINRA, SIPC for securities and investments. Ameritas Advisory Services, AAS, for investment advisory services. AIC and AAS are not affiliated with Keystone Financial Group. Products and services are limited to residents of states where the representatives are registered. This is not an offer of securities in any jurisdiction, nor is it specifically directed to a resident of any jurisdiction. As with any security, request a prospectus from your representative. Read it carefully before you invest or send money. A representative will contact you to provide requested information. Representatives of AIC and AAS do not provide tax or legal advice. Please consult your tax advisor or attorney regarding your specific situation.